Gold looking poised to break through the $3,000 US an ounce mark for the very first time. It has been hitting a record highs. Our guests think, there's plenty more room for gains. Let's bring in Ben McMillian, Chief Investment Officer at IDX Advisors. Thanks very much indeed for joining us. Start off with the central bank buying. Of course, it's unpredictable, but central banks have an enormous amount of power over the gold price.
They do, and it's only dramatically increased really since COVID. So to put this into perspective, last year, central banks collectively purchased over 1,000 metric tons of gold. That was the third straight year of buying at that level. Kind of pre-2021 or 2020, it was roughly 1/3 or less of that. So central banks have been huge buyers. This is part of the larger theme about de-dollarization. And then you now layer on top of that, geopolitical risks, escalating tariff talks, things like that. And frankly, central bank buying shows no signs of slowing down.
And just remind us, why are central banks buying it?
Well, there's a lot of reasons. I mean, it's for the same reason that investors are buying, the kind of the flight to safety premium of gold. But then also, like I said, moving away from US dollar. I think what's been most interesting in recent years, and this really kind of started after the Russia-Ukraine war, was concerns about US dollar assets being confiscated. And that's where you really first started seeing central banks kind of, dramatically ratchet up buying of gold. But it's also concerns about US dollar debasement. It's no secret that the US is running, record deficits. There's concerns about the long-term purchasing power of the dollar. And, central banks like China are saying, you know what, we're not going to play this game anymore. We're going to sell treasuries and buy gold. And to a lesser extent, Russia, and now it's spreading, Poland, India. So, central banks are just kind of doing what they think is a fiscally responsible thing, selling dollars and buying gold.
I always think the Poles, smart people, you should pay attention to what they're doing, are brilliant people. Talk to us about monetary policy. It does look as though the Fed a little while ago seemed to be losing its appetite for rate cuts, but we've had some weak numbers from the US economy since then.
Yeah, I think that's kind of the big bogey this year. So when you look at, kind of structural bull case for gold, obviously the central bank buying is going to show no signs of slowing down. We've got geopolitical tensions. So really, I think, the coin flip is the US dollar and interest rates. We had the central bank kind of ratcheting back on expectations for rate declines. But that said, we got some stubborn inflation numbers here in the U.S. And so I think, a strong dollar is obviously going to present somewhat of a headwind for gold. Even in that scenario, I still think prices are going to be stabilized at around 2,700. I think the more likely case is that we see a little bit of either a dollar normalizing or potentially weakening in the back half of the year. And, depending on who you talk to, they put a gold target at anywhere from, $3,100 to $3,200 an ounce for the end of this year. I think it's at the high end of that range. So to as you said, rightfully so, the real bogey, the potential headwind for gold is potentially higher interest rates or higher for longer. But I think, the structural tailwinds that we talked about are frankly just going to be too strong.
Sorry, you said something like so you see gold getting above 3,000, maybe 3,100, but you said something about stabilizing around 2,700?
I think that's the bear case. So if there's kind of, if we look at two bullish cases for, two cases for gold, the bull case, the bear case, I think both hinge on what the dollar does. And so if in the event that we do get a strong dollar or we get aggressive rate hikes, which I think is unlikely, but possible, that I think that's the scenario in which you would see gold pull back, face some headwinds. But even in that, I think you're looking at kind of $2,700 an ounce. I think that's the unlikely scenario, but it is a possible bear case scenario. On the bull case, I think you have a weaker dollar and a ratcheting up in geopolitical risks. And that's where I think you see gold blow through 3,000 and hit, 3,200, potentially even 3,300 an ounce this year.
The historian Niall Ferguson wrote a piece in the Wall Street Journal saying empires tend to weaken when their interest payments reach the level of their defense expenditures. And he was talking about the Spanish Empire and the French under the Bourbons. But apparently, according to Niall Ferguson's numbers, American interest payments have now reached the level of defense spending.
Yes, I'm a huge fan of Niall Ferguson, and that's one of many different metrics that people look at in terms of even things like debt to GDP ratio, debt to total stock market market cap. But I think that's one of the reasons you've seen in the U.S. a lot of concerns about ratcheting down on expenses, and obviously it's been a hugely contentious topic here stateside. But something has to be done, and I think again when we look at the price of gold, this is the last couple of times we've spoken over the last couple of years. We've talked about this exact setup for pushing gold to all-time highs, and it's a big one. And you look at the rise and fall of empires over time. One of the kind of the easy metrics to look at is just how long do empires last? And 200 years plus or minus seems to be kind of the benchmark. And America, of course, is kind of coming up on that. And one of the problems as empires get to the end, and anybody who's studied the Roman Empire knows this, is you get kind of the ability to, or they think they have kind of an infinite ability to just print money because they're so used to being the de facto standard in the globe. Rome did that. They start shaving off coins and using base metals, and here we are with the U.S. doing the same thing with all the money printing after COVID. And again, that's when we saw central bank purchases ratchet up because they said, "Oh no, we've seen this movie before. We're going to get it into something that's a store of value," which in this case is gold.
I know there's a school of thought that the main reason for the Roman Empire was just to get gold and silver, but we better not go too far down that road. One thing that could go wrong here, though, is the US dollar. Well, one potential headwind for gold is a strong US dollar.
Yeah, and I think that's the big one to keep an eye on, and I think that's going to hinge a lot in terms of what rates do. So, look, I mean, one case with the stronger inflation numbers that we've seen recently, if inflation were to completely become unhinged, and we got back into kind of a 70s scenario where we had a double top of inflation, we know that Powell is very aggressively going to fight that. He has drawn that line in the sand. That's a scenario where you could actually get rate hikes. And again, that I think would really put a cap on gold and potentially move it into more of a defensive posture. But frankly, even in that scenario, I think we're looking at, $2,700 an ounce. And I would have to imagine that central banks and investors would be big accumulators at that level. So, when we think about kind of price outcomes for 2025, it's very hard to see how gold doesn't continue to hit all-time highs, finish the year above 3,000 an ounce. That said, the one caveat is if we got a real resurgence in inflation, therefore got rate hikes, that would put a cap on that.
Thank you very much, Ben. It's great hearing from you. Ben.